if we just jump the rate from 4 to 7, right, or 7.5, we could crush that business, right? That's
Yeah.
not what we want to do. As a small community bank, we say this a lot, we don't develop, we don't run hotels, we don't do any of that stuff. We don't want to foreclose.
Yeah.
We want the business to succeed.
What's up, y'all? Welcome to the Austin Home Guy Podcast. I'm your host, Derek Peterson. Today I'm talking to one of my best friends and commercial lender, Ryan Smith. Say hello, Ryan.
How's it going,
So,
guys? Happy to be here.
So Ryan and I have known each other for a long time. I've done multiple personal real estate transactions for Ryan, and Ryan got into the commercial lending space. So this is a particularly special conversation because I do more residential. We don't often get to work together as much as I would like to. I wish, and you're actually offering some more residential products now, will come down the pipeline for future podcasts, hopefully. But today I thought it would be really beneficial to jump on here and talk about commercial lending, give people some ideas about what's different, from commercial lending and residential lending, some of the basic lingo around that. And then also, when we're in commercial lending, what are the tells of a good loan? What things should people be aware of when they're trying to apply for business loans or commercial loans, and so on? So I think we'll start there. But yeah, so give us the breakdown of your thoughts, the difference between commercial lending and residential lending.
Yeah, I mean, simply put, you've got, single family residence that you're going to live in, and then commercial lending could be a wide range of different products, different deals, whether it's a hotel loan, small apartment complex, large apartment complex, retail strip centers, stuff like that is kind of where that commercial space falls into. One of the confusing things that people may also not realize is that if you're buying a single family residence that you're going to rent out, that actually, constitutes a commercial loan typically. And there's some loopholes there and some stuff you have to be careful of, but it can be a little bit confusing, and you can definitely go down a rabbit hole. There's a lot of different ways people leverage banks, and other types of capital to be able to, make some money in commercial real estate.
So this is going to be a two-parter. What got you into commercial lending, and then kind of transition from that into what kind of banks tend to be the best when it comes to commercial lending?
Yeah, sure. I got into this business, through a friend of mine that worked with the OCC, which is a federal bank regulator. They go in and they make sure that banks are complying within the regulatory part of the business, and that's not just with lending. That's across the board, all the way down to their IT department, to ensure that people's money is safe. And typically, banks are either federally regulated or state regulated. And a good friend of mine that had spent a long time, many years as an examiner for the OCC, found an opportunity with a small community bank, in Texas that was looking for a leader to help them grow regionally. I think, community banks, the second part of your question, versus your regional and then your larger banks. You've got, your Wells Fargo, Bank of America. You may have some smaller regional banks like, I say smaller, but they're bigger than us. Broadway Bank is another one. And typically with those larger banks, they have, you know, very specific buckets that you have to kind of fit in. The nice thing about a community bank that I've really grown to enjoy and love is that we really get to impact people, whether it's a smaller deal, um, you know, under 100,000, and then up to, multiple millions, getting into some of the bigger deals. And, some of it is transactional. Some of it though is just looking at an opportunity for a business that may be kind of in that hamster wheel mode and leveraging debt in the right way. I owned a business at one time and was, not as knowledgeable as I am now. From, the really cool thing that I love is that I see all the different ways different investors leverage banks, for better or for worse, really. But and then kind of reflecting back on my experience as a business owner, I think that's really what I enjoy the most about the role, is looking at a business and then seeing an opportunity where a bank can help, not just make money, right? So
Yeah, dude, commercial lending's cool because it's really all over the map. You get the guy that, is just starting, has no idea what he's walking into, like, and then you have, savvy guys that
dude.
have been working in the commercial, yeah, leveraging commercial lending for like half of their
uh,
life to build wealth through different projects. So you have like
yeah.
this crazy, dynamic of people. Like what typically constitutes a good client for you when it comes to commercial lending?
Yeah, I mean, really, it doesn't matter if they have, if they have a huge net worth or, or not per se. That definitely helps. I mean, cash is king, and anytime, there's cash available in the event of a loan going south, that's kind of your fail safe, really, especially in this market. I mean, you've got all over the place, real estate values are trending and trending down. And then, the cash flow throwing off of these projects aren't really meeting uh, what the leveraged amount of debt is on the project. And then you have interest rates that are in there too. And typically, just to touch on that a little bit, um, you smaller community banks don't have the ability to fix rates for a long time, and we can get into that, when it's when my host tells me it's a good time to go down that rabbit hole, because there's a lot to unpack. There's why I say that. We've
Well,
got
let's jump
yeah,
into that since we're here because like
yeah.
this is the meat of a lot of these conversations, right?
So yeah, I mean, banks, typically are going to price off of, either Wall Street Journal Prime or SOFR, and the different, stick with what I know is Wall Street Journal Prime, and that's the cost of fund, the Fed fund rate, and that's where banks have to make a spread, with the money they're lending out, right? And so
Yep.
the bank that we came in to work for, had a large deposit base because of where they were situated, and not a lot of lending opportunities. And that's why we came in to try to grow the bank regionally, was we needed to lend that money out because there's got to be a balance. But the cost of funds, also determines the cost of funds, and what that means is, what does the bank pay for their funds with their depositors? Are they paying, what are their CD rates? What are they paying for money markets and different things like that? And then when they go and lend that out, they've got to make a spread, and they can't end up upside down. So the reason that explained that part of it is that if we go and we fix a rate for 10 years or 15 years, and then rates trend up or down, right? That can actually end up negatively impacting, where if you've ever had a car loan, and you've borrowed more than you probably should have on it, and I know there's products where you can protect yourself, but you can get upside down on a loan really easily. So if we fix something, in an upward trending rate environment at 6% or 5%, right now Wall Street Journal Prime just went down to, is 675. So if back in 2022, and we might have to do like a fact check on this, but it's probably 4 or something like that. If we were to fix a rate there at, let's say 4.5% for 10 years, and then we lend $1 million on that money, and then the rates go up the way they do, and then our cost of funds go up, we end up we end up upside down, and that's the
Yeah.
main reason that we have to be careful on how long we term out a loan. We don't have a huge underwriting team like a Bank of America would have, where they can really predict trends, and they can also absorb any of that than a small community bank that I work for. So
Yeah.
typically, we're going to fix a rate for 3 to 5 years. It's going to adjust at prime, and it might say, on the loan documents, it would say, after 3 years, you're fixed at this rate. It's going to adjust at prime +1 or prime minus, or might at prime. Typically, it's going to be a prime plus to just protect from, any type of craziness that happens. Um, and then from there, it would adjust, or you might hear the word floating, like a floating rate. And typically for a small bank like us, we're going to do it on an annual basis on the rate adjust. And there is flexibility there, as a borrower yourself, if somebody goes out and you want to buy, an 8-unit multifamily deal and you're with a small community bank and you fix it for 3 years and it's going to adjust, and let's say rates are let's say at the time it was a prime plus one, right? So
Hmm.
at year three, your rate's going to go from 675 to 775 at that time. You can always go to that bank and that lender, and if you have a good relationship, you can negotiate. Yes, it says it in your loan docs, but you can always get a modification done to a loan if it's appropriate and if you're working with the right people. I think
This
that,
is
yeah,
yeah,
we
this is
pride
something I
ourselves on that.
wanted to touch on, yeah, because this is the difference oftentimes between a giant bank and, somebody that's running, a more of a community-based bank because, like these terms, they look at you as real people more as, and I feel like you guys have done a really good job of that because like that's a critical aspect of it. So I think that, when it comes to commercial lending, a lot of people that don't know about this world, their initial instinct, and people do the same thing in our business, right? In residential, where, oh, we didn't know what we were going to do, and so I just went to my bank Chase and got this pre-approval letter. And so I think people that are focused on their business and starting the process of growth, they're going to kind of reach out to whoever they like, the easiest path of least resistance, right? Which is oftentimes just going to be their bank, and maybe not even realize like, okay, this could be, I need to actually talk to somebody that knows what the hell they're doing and can, look at all of the nitty gritty of this and see like, oh, does this make sense on a people level, just not even just a full on business scale level.
Yeah, I mean, at the end of the day,
I mean, at
if
the end of the day, it's the numbers are the numbers, but still,
right.
like you have more leeway. I'm gonna guess with a like a community style bank.
Yeah, and I want to preface it that that doesn't happen that often. Nobody could have predicted that rates were going to do what they did over the course of the last,
Yeah,
5 years. But in those situations, we can be thoughtful about if we just jump the rate from 4 to 7, right, or 7.5, we could crush that business, right? That's
yeah,
not what we want to do. As a small community bank, we say this a lot, where we don't develop, we don't run hotels, we don't do any of that stuff. We don't want to foreclose.
yeah,
We want the business to succeed, because and that's one thing that we talk about a lot as well, is if they succeed, then down the road, there's more loan opportunities for growth. It is a business and we're trying to, banks trying to make money and these people are trying to make money. So if we just jump their rate without really taking a thoughtful process into it, thoughtful approach into it, it's a lose-lose situation. So,
yeah,
I think transparency and communication, back to your initial question about, um, what does it take? What's the definition of a good customer? Communication is huge. My favorite customer that I have so much respect for constantly communicates, with everything he's doing. He provides documentation in a timely manner. That's huge. I mean, when you take out a loan, you have it's in the loan documents. You have to provide annual financials, for example. And
yeah,
there's a lot of, oftentimes we're chasing tax returns, business financial statements, like a profit and loss and balance sheet, that kind of stuff.
yeah.
And when you're having to chase that stuff, uh, it may, from the banker's perspective, when you come back for another deal, that banker may not want to do business with you because they're spending a ton of their time chasing the financials from you, and I think that's also a really important piece.
Yeah, that's good to know, man. Okay, so from on the residential side of things, right? I meet a buyer. Buyer comes in. We go through the pre-approval process. Their pre-approval is usually contingent on their down payment money plus their income. That allows us to calculate, what they can afford in a house, and then we go out and shop for that house, and then once we find a house, we go under contract. They go through the underwriting process where all their financials at that point are sorted through. The underwriter makes sure everything that they said, there was no lies on the application, there was no omitted information, so on and so forth. So walk me through a little bit of what the process looks like on the commercial side. So somebody reaches out, they have an idea of what they want to do. Like, take me through what that process would look like from start to close.
Yeah, the vetting process can be really challenging. I think in residential, you've got a standardized process in place that pretty much everybody understands and follows for the most part, and then you've got real estate agents that can help walk people through that, as well, which is great. On the commercial side, it can be, there's, with larger banks, they're probably going to have an application, right, of some kind, and with us, it's like let me see a personal financial statement, 3 years of tax returns, including K-1s. We need to see the full tax return because typically, if they're investing in a lot of projects, there's a multiple K-1s out there and we've got to see the cash flow. And what we're trying to do, and I think oftentimes, not often, but sometimes people get frustrated with providing financials. And it's like, we're trying to give you as much credit as possible of how your ability is to pay for this debt or show that the cash flow coming off of this property can support it. So, the it can be a somewhat of brain damage going through that process, getting the documentation, especially if you go SBA, and maybe that's a whole nother probably 3-part episode. But I think the important parts, to shorten the answer is typically a personal financial statement. Some banks require their template to be used, but you can download those off the internet, and typically, if they have additional questions, they will ask you. Um, and then on the project itself, right? So if it's, um, I would say a stabilized, let's just use a retail strip center, for example. We'd want to see on the front end, really what's the net income on an annual basis, because your net income is what we're going to calculate to get the debt service calculation ratio, the DSCR. So the DSCR is a ratio that a bank policy, most bank policies are out 1.25 times. So we want to make sure that you can service your payment plus 25%, so that there's a buffer if there's any type of shortfall. Taxes are going up. Maybe there's some maintenance that has to be done that wasn't accounted for on the property. So those are, high level. Initially, that's what we'd ask for. And then once you get into the nitty gritty, you're going to want lease agreements. And there's other layers to that as well, especially if it's a change in ownership where you have a new buyer coming in. There's something that I learned years ago about estoppel agreements that it really protects the tenants from the new buyer. And typically attorneys are going to be involved and vetting all that from the bank side for sure. But yeah, typically we want to get down to what is the net income, how can they pay us back, and then we're able to determine, if you're wanting, let's say you're buying a property for $1 million and you want to borrow 800,000, right? Let's say it's a 20% down, an equity, and then we're gonna lend at 80%, and that's a little high. Sometimes on the commercial side, you're gonna see stuff, if it's raw land with no cash flow, that loan amount's gonna be probably closer to 50%, maybe 60, 65%. And that's different from this specific example with a retail center, but
Yeah.
can it service the debt at that number? And I think oftentimes I'll have, there'll be discussions with the borrower where they're wanting to really borrow up some money because maybe they, want to resurface the parking lot and different things like that. And we use a commercial appraisal to determine value, and typically in a transaction where it's being purchased, we lend on the loan to value, loan to cost, the lesser of the two. So let's say it appraises for 1.2, but the cost is 1 million. We're gonna do our loan amount based off of the cost price of 1 million. And in some scenarios, the borrower can make an argument and say, "Hey, I want to make some improvements that are going to improve cash flow. I want to borrow a little bit more." And with a community bank, there's this word called exceptions, and it's an exception to the bank's policy. And you can always ask,
Yeah.
can I get up a little bit more leverage? Can we use the value because I'm going to do this and it's going to generate more income? I'm going to bring food trucks on site. And then an appraisal is going to actually show a pro forma of projections of what that food truck is going to be in additional income, as well as operating expenses. But in those scenarios, you're going to look at being able to borrow a little bit more money than what you're just, than just the $1 million that you're paying for the property. So
Yeah, that makes
hopefully that
total
cuts
sense.
out. Yeah.
So, did you hit on something in there that I wanted to ask a little bit deeper on because DSCR gets thrown around a lot. I don't because I don't work in commercial lending. I don't know a lot about it. Could you go into a little bit more detail on breaking down like what DSCR is and just kind of how it works?
Yeah, I mean, basically, we're looking at what's the there's DSCR, then there's global DSCR. So global would take into account, typically small community banks are going to require a personal guarantee for a commercial loan, and with a personal guarantee, we're able to account for the borrower's income in addition to the income on the project level. So if it's a little tight, you might be able to get global debt service coverage ratio. But to answer your question in short, DSCR, we're looking at what's the total cash flow
And
net.
just to jump in real quick, just so
Yeah,
people understand, I didn't define the term. So DSCR stands for debt service coverage ratio.
that's right.
Yeah.
Yeah, and typically it's 1.25 times is a pretty standard policy. Um, and what we're
One point
looking
1.25 times what?
So yeah, so it's basically, let's say your debt payment is $4,000 a month, right? So you would need to make you would need to be generating, one and a quarter times more than that to be able to get a loan approved minimum.
Got you.
Yeah.
Yes.
So and we back into it. So we're like, okay, we get this loan request in from a potential deal, and um we're like, okay, here's the net income, less all the expenses. We, got to look at, is there a property management company involved? What are the taxes? What's the insurance cost? And we back into that. We get to the net number. Usually, we can do that if back to your initial question on the good borrower, getting those financials, or for a refinance, they should have those numbers, right? So if they're just trying to
Yeah.
refinance the debt, they should have year end from the previous year or interim numbers. So if we're in Q3, we should, try to get, half the year's numbers so we can annualize that to do our calculations. But yeah, I mean, basically, we're looking at, can they service an $800,000 loan at one and a quarter times? And based on the terms that, when we price something, there's not just the rate, but there's also the amortization. Um, and so we also have to take into account um, the life of the property. If it's a new retail strip center, you might see 25 to 30 years on an amortization. Um, on the schedule per se. If it's an older property or there's more risk, they might shrink that amortization to 15 or 20. And in those scenarios, what the bank is trying to do is just pay the loan down faster, which is really a benefit to the borrower, but typically they don't see it that way, to be perfectly honest.
Yeah.
It just depends on the person's situation. But yeah, I mean, basically, we're going to look at, a 675 rate on $800,000, um, and, on a 25-year amortization, for example. And, based on what, I don't know that off the top of my head, but, that rate produces this payment. They have to be able to make that payment at one and a quarter times, which is very different from DTI, which is what the world you live in. And
Yeah, I
we
was going to say this is like
rarely, yeah, we don't ever use
it's
DTI, not on the commercial
yeah,
side.
DTI is like the residential version of it sounds like DSCR, but
Yeah,
because it's all based on your income and your current debt holdings.
right.
So that's interesting. So okay, so two different scenarios here. So like okay, we've talked a lot about like lending on um commercial property, building land, wholesale. What about business centric lending? Do you do that? Do you like so rather like not physical assets, but
Right.
like an actual business loan?
So we're getting there. We just did one recently for a business, here in town, and I think you do a cash flow analysis where you can look and see what kind of cash flow the business is producing. You might take a lien on equipment to help satisfy your collateral, or you might have a much lower loan to value, on receivables, for example. So if they've got um, customers that they provide a service to or whatever, You look out 90 days of what their receivables are, which they typically will have because they'll have contracts in place with their customers. And we would say, hey, we'll lend 50% of your receivables. And oftentimes I've seen it where it really helps a business get out of a, because they, typically it's like, it's so tight that if we're able to do something like that, it frees up their cash flow to be able to, I can think of one example that was, they delivered sod and they had a crazy amount of demand, but they needed to buy one more truck and they had commitments, to warrant buying another truck, to be able to deliver more sod. And you do the math and it makes a ton of sense, but typically your rate's gonna be higher, so you're
Yeah.
probably 8, 9%. It's a higher risk. These rates come from people we discuss it as a group. We have a committee that meets, and we've got credit analysts that, get down in the nitty-gritty and do the financial spreading of all the numbers, and then we'll look at it and say, you know, based on the risk profile, this is how we want to price it, you know, appropriately for the bank. Cause I mean, at the end of the day, we have shareholders that we have to answer to.
Yeah.
And so, there's a lot of times that, not a lot, but it happens where people are, oh, can you help me out? I'm like, I'd love to help you out. And there's ways that I can help you out with certain terms, but there's certain things I just don't have control over, unfortunately.
Yeah, of
Uh,
course.
Private equity
Yeah.
is different where they can, that's a whole nother ball game. Or, a loan from a friend, that's different, but, we'd have to answer to those shareholders, on a monthly basis. So,
Yeah, which totally makes sense. So, okay, um, so on a typical commercial deal, I imagine that there are things that typically blow up deals, and things that don't. What's the biggest mistake you see people commonly make in the commercial world?
from my experience directly, I think construction is just one that is really scary. When you're talking
Mm.
about, there's just so many things that can go wrong. And if you've got a seasoned person or it's yourself that you're looking at, maybe you're trying to build something that, could be a really great asset for your portfolio. You have to really know the ins and outs of the city and the inspections because that can crush you. I've seen it in both San Antonio and Austin, um, good and bad. I've seen guys and girls both know that they know the ins and outs of that city municipality and how it works and how it functions. And then I've seen people try to go from one city to the other where they're not as knowledgeable and get crushed. That and then the general contractor part is just, I mean, there's great ones out there. Don't get me wrong, but it's kind of the Wild West, in a sense. It's hard to control it. There's Texas. I think understanding Texas law is really important when it comes to construction. But yeah, I think that's been the one that I've seen, where you have this grand idea with this parcel in a downtown area, and if you don't know the inner workings of that, or, um, I think understanding pie in the sky type things, oh, there's
Yeah, I
this,
was gonna say,
go ahead.
yeah, does that impact, like, do you guys take into things like that when you're considering lending on a deal? Because, like, for example, like what you just said, somebody maybe has developed in, a small city in like South Texas, right? And they knew the ins and outs of it. They built up a small community of new development, successfully sold it all the numbers worked. Then they come into like someplace outside of Austin where, there's much more red tape around building different things. And, time is money when it comes to, if you're talking about building anything, like once you accept money from a bank, you are on the clock. So you are trying to produce a
Yeah.
product as typically as quickly as humanly possible to create, cash flow and sales. So when you're looking at lending on some of these deals, does their experience in and around what they want to do impact y'all's ability and willingness to lend on certain things?
Yes and no. I mean, we've got it really is a trust thing, right? I
Gotcha.
think
Yeah.
that, we know that, there's a saying that your first loss is your best loss. And what that means is taking the loss early when you realize the project is going south is much better than waiting for whatever to happen, because it's only going to get worse. And I've seen it, unfortunately. And so, I think the biggest thing if you're gonna do something like that, is really vet it. I mean, you both sides. The bank, I think as a steward of the bank and as a steward of the customer that's coming to borrow money from me as a loan officer, um, I owe it to them to, um, in a sense, sometimes protect them from themselves and say no, you know?
Yeah.
But it is, small community banks is so relationship driven. And we have to be conscientious of, hey, this is a new market, and we've learned as we've moved into Central Texas in the lending space of some of these local municipalities, and we're members of various economic development funds, and that also helps immensely. But yeah, I think that, specific to construction, you have to know what's the vision of the people that are driving that community, as far as the city planner goes. Are they pro growth? Are they slowing things down? Some I've seen some, like,
Yeah.
just the impact fees alone. Impact fees are what you pay to turn the water onto your site, right? I've seen those triple because certain cities are wanting to slow the development down because it's grown so quickly. And they have their reasons for doing that. And that's something that, I'm not part of those conversations, but, if you see something like that, that'd be a big kind of like, maybe I don't want to develop in that town. Let's look
Yeah.
at some more pro growth. And I think if you're going to get into the development space of, or you're already in it and you're going to go, is finding the economic development funds that are tied to those specific cities and going to those meetings and listening before you jump into a big deal. Um, you know, if it's not construction though, stuff that can kill a deal. Um, I mean, there's so many things that you could say. I think bringing up, I think putting in, if you're going to do a deal, I think putting in as much of your own cash as possible is key. You're going to get better terms, and then in the event of something going south, you'll be able to not owe money to the bank if you had to fire sell something. I
Yeah.
think that's and you can raise capital through limited partners. That's something that I've seen done a ton where, yeah, you may not have, several $100,000 laying around to invest in a commercial project, but you can uh, have limited partners, general partners, those types of things that can help with that equity piece. You're going to owe them some kind of return on the back end, right? But
Yeah.
it's going to get you better terms. And if something goes south, you can sell the property without owing money to the bank. So
Yeah, I mean, unless you're a savant in the real estate world and you just can like predict deals beyond, like, you're gonna have to have some major skin in the game to make a commercial deal work in general anyway. So like,
yeah,
and most of the people getting into commercial realize that, recognize it. But that, I guess, let's like land the ship here, because I think this might actually be a good uh kind of final thought to leave on is, what kind of collateral and assets are you looking for when you're doing these commercial deals? Like, what kind of, like, what can people use to secure a commercial deal that may be different than, what they could do in the residential? Well, I mean, your collateral is your income in the residential
yeah.
world, so you're
Well, yeah. I mean, to answer your question, I think there's, the straightforward stuff. Small retail centers. Is one that comes to mind. Those are obvious. Hotels, um, even,
so
you
you use the it more often than not. Like, are there like, using the property that's being purchased in question, that's the obvious collateral, right?
yeah.
I'm kind of more speaking
Okay.
about, in general, like, me and you have had side conversations where, people have had to secure further loans or different things. They've had to have potential other collateral in place to ride against. Uh, like, is that
Yeah.
like, in what situations is that possible, I guess? Because
Yeah.
sorry, I should have clarified that
No, you're
when
good.
I
You're
asked the
good.
question.
I mean, there's, are you referring to kind of notes receivable lending? Or like, because there's that type, there's
Well, meaning like, okay,
equipment.
so
Go
say for
ahead.
example, somebody doesn't like isn't the strongest, uh they don't have a ton of cash on hand, found a killer deal on commercial property. All of the numbers make sense except for they're either A, their cash flow, or B, it's riskier because of, XYZ on the commercial side. You know, is there situations where you take into account other collateral or assets from that buyer if they've been in business for something similar, like for example and I'm bringing this up specifically thinking about developers, right?
Yeah.
Because you see a bunch of developers right now that maybe over the last few years have struggled to sell homes that they've started projects on, but they also are, if they're in it for the long game, it doesn't mean that you stop developing. So you may not, you may be leveraged hard or have, may not look great on paper at the moment, but there may also be a deal to secure. So in situations like that, what does the lending look like?
Yeah, I mean, I mean, it's definitely one of those things where you have to, you have to get the whole picture of that person's, balance sheet, obviously, and you can look for different things. Like, I mean, there's ways where, I guess a specific example would be if somebody had multiple, rental properties. You could take second liens on those rental properties and the equity that's in there. That could be an additional collateral in a situation where the deal is super strong. You just got to get it to the finish line, get it stabilized, whether that's leasing it up or, getting it developed, or, what really is just getting it, in a situation like that, you're just trying to get it leased up, whether it's an apartment complex or a retail strip center. You can also bring in other partners that are just that would be paid a fee on the back end that could bring as a credit enhancer. Um, there's different things like that, but not. I mean, really, from a collateral perspective, the hardest thing, uh, if it's not real property, it can be challenging. It can be. That's something that we run into from time to time. You can do, um, I guess you could put a lien on the receivables, for example, if they've got cash flow coming in. But yeah, I'm not sure if I'm answering your question real well, but
No, that
I
makes
mean,
sense.
it's yeah,
You're basically like,
it's
it
tough, man.
doesn't really happen,
It
and
it's
it's really
it
challenging to do
it
that if
is, man.
you,
Well, and I
especially,
mean, you got to look at a worst case scenario, right? Like everything
yeah,
we have to look at, okay, if we had to take this back, right?
yeah,
Or if we had to be paid back for whatever money was borrowed, how can the bank be made whole? And usually, as soon as a bank forecloses on real estate, for example, there are people out there that are looking for those deals, and they
oh
know
yeah,
that typically a bank has 2 years to offload a property that they can't sit on it. We just we're by the regulations, we can't do that. We have to sell it, and typically it's sold at a discount. Um, and so that's why the over leveraging a property is that's a deal killer, really and
yeah,
truly. I mean, even if it's ever tight, like if it's a startup or something new, or let's say it's something that needs to lease up, um, you really want to be really conservative with your own initial underwriting, and look at worst case scenario. I think baking in, this kind of goes back to an earlier question you had, but yeah, the minimum is 125, but let's bake in, let's plan for 1.3, right? Let's try to get that, and then also let's plan for what happens if rates go up, you know 200 basis points. What happens in that scenario? Does this deal still work? Does it still paper? Because the best thing you could do is walk on a deal. I
yeah.
think that's, that's probably the hardest thing, especially when you've done all the analysis, all your chips are in, like you don't want to not do the deal at that point, but um that can kill a deal or save you. If you try to force something that you're just trying to make it work and it's tight, that'd be the first indicator to walk away,
Dude,
honestly.
that's
Yeah.
legit. Well, dude, this is a great start to some awesome lending conversations. I think this was I learned a lot from this because
Nice.
I don't deal in commercial very often, and I had no idea prior to us talking about this what DSCR was. So
There you go.
always learning new stuff. So
Yeah, man.
yeah, dude, we'll do another part of this, some commercial lending questions and so on in coming weeks. But yeah,
Sure.
signing off here. Thanks, man.
Thank you.